Your mortgage rate right now is somewhere around 6.5%. Your bank didn't choose that number. The Federal Reserve didn't choose that number. You didn't choose that number. A market chose it. A $145 trillion market that 95% of Americans have never once looked at in their entire lives. That same market decided how much your car payment is. It decided what your 401k is worth this morning. It decided whether your employer can afford to keep hiring or has to start cutting. And in 2022, it caused the so-called safe part of millions of American retirement accounts to lose 16% in a single year. Not the risky part, the safe part. By the end of this video, you will understand exactly how this market works, why it controls your life, and in real dollar numbers, what every single move it makes costs you personally. Let's get into it. Before anything else, forget every complicated definition you've heard about bonds. Here's the real version. Every day in America, massive things need funding. New highways, cancer research hospitals, Amazon warehouses, military equipment. None of that gets funded with a credit card. So the U.S. government and major companies do what any smart person does when they need a large amount of money fast. They borrow it. But instead of borrowing from one bank, they borrow from thousands of investors at once. Here's the deal they offer. You give them $1,000 today. They promise you a fixed interest payment every single year, called the coupon. And on a specific future date, called maturity, they hand your full $1,000 back. That's a bond, a legal promise, a fixed deal, a loan with a schedule. Now here's what makes bonds powerful and dangerous. Once you buy one, you can sell it to someone else before it matures. And that's exactly where the chaos starts. There is one rule in the bond market. Just one. And once you understand it, every financial headline you'll ever read will make sense instantly. When interest rates rise, bond prices fall. When interest rates fall, bond prices rise. Opposite directions. Every time. No exceptions. Here's why. With exact numbers. You buy a $1,000 bond paying 3% interest. That's $30 a year coming into your pocket. 4 months later, new bonds come out paying 5%, $50 a year. Same $1,000 investment. Now you want to sell your bond. Nobody will pay you $1,000 for a bond paying $30 when they can buy a brand new one paying $50 for the same price. So your bond's price has to drop all the way down to around $600 until the $30 it pays is competitive again. You haven't lost any future payments. The bond still pays $30 every year. It still returns $1,000 at maturity. But right now, today, your $1,000 investment is worth $600 on paper. Burn this rule into your memory. Every disaster I'm about to show you is just this rule, operating at a scale that touches every American family. Meet Marcus. Marcus is 32, works in logistics in Columbus, Ohio, saved for 4 years to buy his first home, found the perfect house, $375,000. He's sitting across from his loan officer, ready to sign. His bank doesn't invent his mortgage rate. It looks at one specific bond, the 10-year U.S. Treasury, currently yielding 4.5%, then adds roughly 2 points for the risk of lending to a real human being who might lose their job, get sick, or hit hard times. Marcus's mortgage rate today, 6.52%. His monthly payment on $375,000, $2,381. Now, the bond market has a rough week. Investors get nervous. Inflation data comes in hot. The 10-year Treasury yield jumps by just 0.5 percentage point. Normal move. Happens in a single trading week. Marcus's mortgage rate rises to 7.02%. New monthly payment, $2,503. That's $122 more. Every single month, for 360 months. Over the life of his loan, That half-point move in a bond market Marcus has never visited cost him $43,920. He didn't do anything wrong. He didn't pick a bad house. He didn't choose a bad bank. The bond market moved, and Marcus paid the bill. Now watch what happens when you zoom out. January 2021. 30-year mortgage rate, 2.65%. Marcus's monthly payment on the same loan, $1,501. October 2023. 30-year mortgage rate, 7.79%. Marcus's monthly payment on the same loan, $2,688. Same house, same Marcus, same income, same credit score. The difference, $1,187 every single month. Over 30 years, $427,320. The bond market handed Marcus a $427,000 bill without ever sending him a single piece of mail. Now I need to tell you something that hurt millions of American families in 2022. And if you have a 401k, or your parents do, pay close attention. For decades, every financial advisor in America said the same thing. As you get older, move out of stocks and into bonds. Stocks grow your money. Bonds protect it. The classic 60% stocks, 40% bonds portfolio, sold as the safe, responsible, conservative choice. 2022, the Federal Reserve raised interest rates faster than any point in 40 years, near 0 to over 4% in just 9 months. Apply the rule. Rates went up. Bond prices collapsed. The entire U.S. bond market lost 13% that year. Worst year in the index's recorded history, going back to 1976. The S&P 500 fell 18.1% the same year. A 60-40 portfolio, the safe choice, lost roughly 16%. The seatbelt failed. And here's the detail that made it devastating. There's a number called duration. It's printed on every bond fund's fact sheet. Most investors have never looked at it once. Duration tells you how much your fund loses for every 1% rise in interest rates. A typical broad bond index fund, duration of 6, 1-point rate rise, you lose 6% of your investment. A long-term treasury bond fund, duration of 17, same 1-point rate rise, you lose 17%. 2 retirees, both with $500,000 saved, one in a duration 6 fund, lost $30,000 in 2022. One in a duration 17 fund, lost $85,000 in 2022. Same rate move, $55,000 difference. Neither of them knew what duration meant. Duration is the difference between a bruise and a broken leg. One number. Millions of Americans never looked it up. Here's something most people don't know, and it's the most powerful forecasting tool in finance. It's called the yield curve. Simple concept. The U.S. government issues bonds across different time periods, 3 months, 2 years, 10 years, 30 years. Normally, the longer the bond, the higher the yield, because locking your money up for 30 years is riskier than 3 months. So investors demand more pay for longer commitments. Right now the curve looks like this: 3-month Treasury, 3.71% 2-year Treasury, 4.09% 10-year. Treasury, 4.50% 30-year Treasury, 5.00%. That's a normal curve. Short rates low, long rates high. But sometimes, the curve flips. Short-term yields rise above long-term yields. The 2-year starts paying more than the 10-year. That is called an inverted yield curve. And when it inverts, the bond market is making one specific prediction. The economy is about to slow down. The Fed will be forced to cut rates. A recession is likely coming. How accurate is this signal? According to research from the Federal Reserve Bank of San Francisco, every single one of the last 10 U.S. recessions going back to 1955 was preceded by an inverted yield curve. 10 for 10, over 70 years. No economist, no algorithm, no indicator comes close to that record. The bond market doesn't shout its warnings, but when the yield curve inverts, it is making the loudest statement in all of finance. Okay, here's exactly what to do with everything you just learned. 1. Look up the 10-year Treasury yield right now. Google it. Takes 5 seconds. When it climbs, mortgages, car loans, and business borrowing climb with it. When it drops sharply, the bond market is bracing for a recession. This is your economy's check engine light. Now you know how to read it. 2. Find the duration on every bond fund you own. Open your 401k app. Find the bond section. Pull up the fund's fact sheet. If duration is above 7, you have real rate risk you need to understand. Above 15, that fund is behaving more like a volatile stock than a safety net. 3. Stop parking cash in a 0.38% savings account. That is the national average at America's biggest banks right now. Meanwhile, 3-month Treasury bills yield 3.71%. Top high-yield savings accounts are near 4.20%. Both are just as safe, FDIC insured or Treasury backed. Marcus has $45,000 in a standard savings account, earning 0.38%. That's $171 a year in interest. Same $45,000 in a T-bill at 3.71%. $1,670 a year. Zero extra risk. $1,499 more per year. $7,495 over 5 years. Free money. Marcus is leaving on the table every single year. 4. If inflation worries you, look into I-bonds. U.S. Treasury issues them, currently paying 4.26% through October 2026. $10,000 limit per person per year. The most direct inflation hedge available to a regular American saver. The bond market is not something built for Wall Street traders. It is the invisible foundation that every dollar in your life sits on. Your mortgage, your savings, your retirement, your job security. All of it moves when this market moves. The people who understood this in 2021 locked in 2.65% mortgages. The people who understood this in 2022 got out of long-duration bond funds before the crash. The people who understand this today are earning 10 times more on their cash than their neighbors. They are not smarter than you. They just looked at a market most people ignored. Now you have too. If this video changed how you see your money, subscribe, because the next video is going to show you exactly how the stock market is secretly priced by this same machine, and what that means for your portfolio right now. See you there.